there will be a time where Bitcoin and the fiat system fight, and obviously we want Bitcoin to win. So housing is more abundant now than it's ever been. We've got more housings per people than we ever had. What we're going to see over the next decade is this increasing desperation by governments to keep the system going. And all you really need to do, right, is buy Bitcoin, and your life is going to be so much simpler.
Alrighty guys, welcome back to Satsventure. Today we have a very special guest, someone that is not only holding cold storage Bitcoin, but is also trading some Bitcoin and mucking around with a little bit of the treasury companies as well. So someone I wanted to bring on to bring in a different light to the conversation. So welcome aboard, Mangosteen.
Hey, thanks, Joe. Thanks for having me on the chat. I'm looking forward to this chat.
Yeah, I'm looking forward to getting into a little bit of trading and some other ideas that a lot of Bitcoiners are too scared to talk about. And so I'll give you the floor at the moment now to introduce what your life was like before Bitcoin, how you found Bitcoin, and how it's changed your life now.
Yeah, for sure. So I came into Bitcoin. I think the story is, when was the first time you ignored Bitcoin, right? And the first time I ignored Bitcoin was when it hit $1,000 for the first time in like 2014. And my story was like, what's this fake internet money? Like, it's hit $1,000 a coin. This sounds like a scam. It'll crash. Like, it'll just like control paste, and you can copy digital coins. I don't see why there's any scarcity associated with this. So these things will crash. And then of course, Bitcoin did crash subsequently in 2015, 2016, right? And it was down about 80% to like $200 a coin. And I can remember thinking at the time, oh man, I'm a genius. Like I've predicted this crash. I know everything. But I did make a little note, and I said, this is interesting. It crashed, but it didn't crash to zero, which is what I would have expected. It crashed to $200. So I made a little bit of a mental note to myself to say, hey, look, if this ever hits $1,000 a coin again, I will devote an afternoon to understanding what it is. And then, of course, early 2017 arrives. This is sort of 3 years later, 3 years later, and I hear that Bitcoin somehow I've just heard that Bitcoin's hit $1,000 a coin again, and I'm like, that's interesting. So I said, you know what, I'm gonna devote an afternoon to understanding exactly what this is. So I just parked everything, and I was always interested in like finding opportunities, right? So like it had sort of come back on my radar, and I fired up YouTube and I started researching Bitcoin. And I can remember watching this video called Bitcoin Under the Hood on YouTube that sort of showed how Bitcoin was technically implemented. And I thought, ooh. And I came from a background of engineering and economics. Like, I'd studied engineering and economics at school. And so the merging of the technical and economic concepts to me weren't foreign. And so when I watched that video, I was like, oh wow, this is going to change a lot. Like, this is transformative. This is very powerful. And so that to me was a massive light bulb moment. And that's when I started playing around. I, put my first $50 in or whatever, and sort of had to play around with the, public and private keys and understanding exactly what you could do. And in those days, you couldn't there were like exchanges and stuff like that, but it was still kind of quite early, and it was a bit Wild West, and you didn't really know what you're doing. And so there was all these other ways in which you could possibly go wrong. And that's kind of how I started my journey. So that's when I started really, really thinking about Bitcoin. And of course, I rode up the 2017 bull market, made some amazing gains, and came into Christmas time and talked to my family about it. I thought, oh my God, guys, like, this is amazing. And then, we had the subsequent crash in 2018, 2019. And I can remember really distinctly thinking, this, I think, is an opportunity, not like I'm not like I've lost money, but I think this is the opportunity. This bear market is the opportunity. And I can remember sort of doing some rough numbers and sort of like discussing where people thought Bitcoin could go. And I thought, if I commit to this right now and really, really go hard, then this could be life-changing. And so that was when I sort of made the commitment to say, yeah, I'm going to go really hard and focus on this for the next like few years. And that was sort of the beginning of my Bitcoin journey. So that's how things have changed. I've changed, Bitcoin hasn't.
So what was your journey like, going from finally holding Bitcoin, letting it sit on the side, sort of start to run and accumulate as much as you could, and then sort of decide, all right, I want a percentage that I can sort of muck around in the market and try and trade? So like, what was that sort of beginning of that trading period?
Yeah, so I went through probably the same cycle that a lot of people go through, and that is you find Bitcoin, you learn about Bitcoin, and then you get distracted with all the altcoins and you go into like diversification, or this idea of diversification. You hold all these like junk coins for years and you lose a bunch of money on them, and then you dabble in trading and you lose a bunch of money on that, and you finally and eventually come to the conclusion that you're Bitcoin only. And that's the conclusion that I came to, like, I probably only just in the last couple of years, where I'm like, I am Bitcoin only. I only care about Bitcoin, and I'm not interested in anything else. And so that's that journey is typical of everyone. But going through that journey, I spent a lot of time looking at charts. I spent a lot of time trying to analyze Bitcoin, trying to find any sort of way in which I could trade this, because it was so volatile and the opportunity was so great that I felt like it was something that like would be a life, like a worthwhile venture to like really analyze. And so I spent 8 years trying to trade Bitcoin unsuccessfully, and it's only really in the last 2 years that I'm starting to get really confident in my ability to trade Bitcoin. And that's sort of the journey I've been through. So I've gone through learn about Bitcoin, go and spend some time shitcoining, then get burnt, trade, get burnt, and then come and find this like nice little balanced niche around how to do something sort of secondary to Bitcoin. Because obviously, um, if you are Bitcoin only, which is certainly like probably the best place to be, you are still like you're still sort of stagnant, right? Like your participation in the market is not financialized, and that is the philosophy of Bitcoin, right? Like the philosophy of Bitcoin is proof of work. Go into the market, produce work, produce labor, produce value, and receive that and convert it into Bitcoin, and then sit on it, right? And that is the purest philosophy of Bitcoin, and probably the one that you should generally follow, right? Um, but you are sort of stagnant, right? Like if you do find yourself in a position where you do have to draw down on your Bitcoin while you're selling Bitcoin, right? Like you very quickly find yourself in a position where you're selling Bitcoin. And now Bitcoin is really volatile, and so you can find yourself in a position where you may be selling Bitcoin at really, really unfavorable prices. And so there's always been this mindset of mine that I don't ever really want to sell my Bitcoin under any circumstances. And so I need some sort of buffer that can wear me through those hard times to ensure that I never find myself selling Bitcoin, because that's the last thing I ever want to do. And so that's sort of the philosophy that I've been applying for, is like, what is the balance between cold storage Bitcoin and then having enough Bitcoin active in the market such that it's building resilience and insulation against my main stack that I never ever want to sell. So that's kind of the philosophy that I've been applying.
But I think something that scares a lot of Bitcoiners away from this idea, including myself, is just we've seen like what can happen in altcoins and trying to buy and sell those things. And I remember dabbling with meme coins and stuff like that, where to me now that's all just a distraction. And I think I often put the treasury companies and things like that in the same box. And so could you maybe go into how you distinct self custody Bitcoin, cold storage Bitcoin versus the ETF strategies, dividends, all those types of things, the treasury companies? Who do you think should be buying those compared to cold storage, and why should it be something people should consider, even if you're a Bitcoiner, just to generate that extra income?
Yeah, and I mean, I've got some like small horror stories where, back in 2017, 2018, I've introduced friends to Bitcoin. I've said, hey, get this app on your phone, chuck some Bitcoin in it, $500, $1,000 or something, which at the time was not mega, mega, mega money, but it was, it was money. And they've not really appreciated what they're holding. I've then carefully got them to write out their seed phrase, and then they've gone and put it in a notebook somewhere or something like that, and they've gone and lost it, not really understanding what they're doing. And then subsequently, those Bitcoins are worth $40,000, $50,000, and they can't find that seed phrase. And I think a lot of people see cold storage as the risk-free holding, which is not true. Like there are risks to self-custodying your own Bitcoin. I've had moments where I've been a little bit nervous about whether I've completely tracked all my Bitcoin or not, or if I've had an issue or something like that. And so, you know, cold storage Bitcoin is definitely a great place to store a large portion of your portfolio, but you also have to be very careful about that there is risks inherent with that. So, for example, I own the vast majority of my portfolio in cold storage Bitcoin, but I also own some ETFs. And if I'm ever talking to people at the moment, I actually recommend that they start with ETFs, because self custody requires a very high level of engagement and very high level of technical understanding of Bitcoin that your general investor is probably never going to have. So I nowadays recommend people start with the ETFs. And if they want to get serious about Bitcoin and they start accumulating large amounts, then I say, hey, look, you should really start considering cold storage. And so I think that's a really a good niche for ETFs as the beginner, that, sub 10,000, sub $20,000 worth of Bitcoin. You probably staying with ETFs is probably not a bad place to start. And then, of course, you've got your MicroStrategy component, right, which is that opportunity to increase your Bitcoin per share, right, through the use of what is essentially a speculative attack on the fiat system, right? I'm going to build up leverage. I'm going to use that to buy Bitcoin. That's going to strengthen the price of Bitcoin. That's going to strengthen my balance sheet. That's going to improve my debt to equity ratio. That's going to make me more able to take on more debt to buy Bitcoin, right? And it becomes this positive, self-fulfilling flywheel of Bitcoin accumulation. And that has its own risks as well. Like if I were a sovereign that was, a little bit in need of recapitalization after my debt issuing has gone a little bit awry, then the ETFs and MicroStrategy and Bitcoin treasury companies would be a big honeypot, right? But at the same time, they also are that vanguard of introducing Bitcoin to the mainstream market. And I mean, if we want Bitcoin to win, it's going to have to come up and integrate with the fiat market, and then eventually subjugate it, right? And it's not going to be this thing that just sits in isolation and runs parallel and totally disconnected. It's going to have there will be a time where Bitcoin and the fiat system fight, and obviously we want Bitcoin to win, but there's going to be this that is going to be a natural part of the Bitcoin maturing journey, is to take on the fiat system and integrate with it and overcome it.
Yeah. I think Bitcoin's interesting because it's definitely a case by case for what you should start with and what you should do, because I think if you had a whole bunch of, not necessarily even boomers, just people beyond millennials, like in their 40s, 50s, just go, oh yeah, but get this exchange, do this, yada yada yada, then just withdraw it here. Here are your seed phrases. Like the chance of them losing it is like ridiculously high, and so I can just imagine trying to do that, even with my own dad, who I've introduced to Bitcoin. If I had just rushed that whole thing, like the man can't even remember his password to a basic email. Like I can't imagine him trying to remember, whether it's 12 words or 24 words. And so I've been really careful with introducing people, even like my siblings or my friends, where I don't just rush them in and go order the cold card or Blockstream Jade, like order these things and do this, because it would probably scare them away already. Like it's too much information as a beginner. And if you don't understand what you're holding, you don't understand why you might want that security. And so I think there is a world where ETFs do have they're part of the picture. And I think holding on an exchange temporarily is part of the picture. And I think although cold storage to me is the superior storage and security for Bitcoin, it's not just a one size fits all straight away. And I think that is your long-term goal. Like I think especially as you get older and older, and maybe you're talking about inheritance and things to pass on to your kids, I think you would rather have a fair chunk in cold storage with a proper inheritance plan than having it all locked up in the existing traditional system where people can just take a piece of the pie every single step. That's what I'm saying. So I think, yeah, there's obviously pros and cons to all of these things. But yeah, it's definitely not a one size fits all. Like it's not just rush into cold storage. I think people have to do a lot of research before they do something like that, because it is pretty sophisticated.
Yeah, definitely.
Something
I think the best approach to cold storage is for someone to realize and want to do it themselves, than necessarily someone like forcing them down that channel and then they've not really understood exactly what they've done, because it can be pretty disastrous.
Something more just to dive into is the idea that a lot of people think that you can earn this passive income from dividends, from these things, and sit on the sidelines, and they feel like they don't have to move their money around as much. Is this something that you believe, or do you think you have to be active in the market if you want to get those gains? Or is there a product or something that you see that people should have a look at to just sit on the sidelines?
Yeah. I'm in a sort of a slightly different life stage at the moment. Like, if I were a Gen Z, like I would be prioritizing growth and buying as much Bitcoin as I possibly could, and then probably also like dabbling in some MicroStrategy to boost that growth to a certain ratio that person felt was appropriate. And then, I'm in a sort of a different stage where I do need some income. I do want to have some cushion to make sure that, when lean times are ahead, I can feed my family and keep them in the lifestyle that they're used to. And so, I've really started to build a bit of an interest in STRK or Stark, the MicroStrategy income component, because that gives me income, but then it also gives me that upside exposure to the MicroStrategy price, which is obviously a proxy for Bitcoin. And so I really like that product because it gives you the income now, but also allows you to have that exposure to the upside over the long run. So I've been buying that actually quite a lot lately with any sort of spare funds, and then obviously I do my Bitcoin trading, and I keep my earnings from Bitcoin trading denominated in Bitcoin itself. Obviously, with the limitation that it's on exchange, which is not ideal.
I believe 60% a year is something that's really tough to beat. And so when people look at houses as an investment, what would be your opposing view to say, hey, maybe you should have a second look, because houses aren't necessarily going to do the same repeat they've done for the last 30, 35 years in Australia, and they're potentially actually trending to zero against Bitcoin.
I think, like you say, yeah, Bitcoin is the new hurdle rate. If you can't beat it, you need to buy it, right? But Aussie property, and I mean property in general, like if you think of property across the entire Anglosphere, has been sort of this fake market for 50 years. And it's sort of the trends that have supported that property boom that the boomers have enjoyed so well throughout their life are actually coming to their logical end, right? And boomers bought their properties in like the 70s or late 70s or early 80s, right? And global population was booming at that stage. And not only that, they had a robust workforce where labor participation by women wasn't actually that high. And so what you've had over the last 40, 50 years, right, is you've had this boom of global population and then the subsequent bust, right? Like fertility rates have absolutely and utterly declined, which is going to make immigration harder to actually achieve, to boost populations. And then you've had the participation of women in the workforce, which has been a great thing, but it's maxed out, right? And it's no longer able to generate growth in the economy like it used to, right? Like traditionally between the 70s and 90s and 2010s, that slow introduction of women into the workforce was a growth mechanism, right? It was a deflation mechanism, and that actually kept prices at bay and suppressed wage rates and stuff like that to keep this sort of fiat system going and keep the money flowing into the property prices. And so, like, we can look at it, and I mean, there are two trades. There are two sides to like any property transaction. You've got the real estate asset, that is the real asset, and then you've got that nominal asset, which is the medium in which you're transacting. For you and I, it's like the Australian or New Zealand dollar, right? And to understand any transaction economy, you have to understand both. And we can start looking at this hurdle rate in these slides I'll show you. So we all know Australian property has outpaced incomes, right? And we can see here the full-time employees' income versus the median house price, and we can see a massive divergence from the early 90s, but that has been diverging since like the 70s quite clearly. Now, the typical story is that there's a lack of supply, right? Like everyone talks about this lack of supply. And if we look at annual dwelling completion rates in Australia per capita between 1960 and now, per 1,000 people, our completion rates have slowed, right? And that's indicative of potentially a supply constraint. But when we look at the total housing surplus, or the housing stock, we're still building houses at a rate faster than what they're depreciating or they're being removed from the economy, right? Because obviously you build a house and then it deteriorates over time, but our rate of building houses is in excess of what we're losing. And we can see that really clearly here. So we've got dwellings per capita across the entire Anglosphere: New Zealand, Australia, the US, Canada, the UK, and across all 5 of those nations, dwellings per 1,000 people has increased over the last 30 years, right? So housing is more abundant now than it's ever been. We've got more housings per people than we ever have. And so where's the supply constraint, right? And I mean, you can argue that, there's some preferences around people wanting to live individually or in single homes or something like that. But fundamentally, housing is more abundant today than what it was 30, 40 years ago. Now, the reason for that is that houses have been monetized. We're using them as savings accounts. And our experience of housing is on the left graph, right? So if we see on the left here, we've seen New Zealand, US, UK, Australian, Canadian residential housing prices, their indexes over the last 30, 40 years grow, in Australia's case, about 6% annually, right? Which is broadly people's experience. Like, houses have gone up in value and our ability to buy them has become impaired because our wages don't keep up, right? But when we adjust for house prices, but for money supply, and in the case of Australia and New Zealand, I've used the M3, which is essentially a broad measure of money supply in the economy. We can see that actually house prices have gone backwards when you adjust for money supply. So you can see here, house price index, when adjusted for money supply, Australian housing has gone down on average 2.2% a year, right? So houses have gotten cheaper. And if we look back at that housing supply, if we take the rate of money creation and we minus the rate of new housing or new dwelling supply, that broadly aligns with the price growth rate of these houses, right? So houses have done nothing but absorb the liquidity being generated in the market for the last 40, 50 years, right? So houses have just been a monetary asset that we can leverage. And that's why they've been such a high-performing investment asset for boomers, right? They were able to take out leverage. They were able to basically be dollar short, and they were able to be a dollar short against a relatively more scarce asset than money, which was the houses, right? Which only grew at like 2% a year. And so the only time where we've seen, house prices exceed the rate of money creation is actually just prior to the GFC, right? Housing went into a bubble, right? And that's a really, really good indicator of a bubble. If you want to see a bubble in the market, is the price of this asset climbing at a rate faster than money supply? And is it doing that unsustainably? And so you can see here, we came up, we had GFC, we had the big crash, and then we went back into that long-term trend rate of sort of the slow decline in house prices when adjusted for money supply. And so that's what's really happening across the entire world, is houses are just absorbing liquidity and a proxy or a savings account that people can leverage.
But how can that continue? Like here in Australia, say I'm looking at houses just getting further and further away from me. Like now the median house in Australia is approaching $1 million. And I'm not coming up with that sort of money. Like even the deposit is something that I find I would struggle for. How can, like if the median house price just continues to go further and further up, but I'm only getting like a 1 to 2% raise, that just means Gen Z and this whole, even I'd say millennials that are trying to buy a house, how are they ever going to afford a house? And are the prices just going to continue to get to a point, or are they going to pop like 2008?
Yeah, I think fundamentally, like, house prices can go up forever, and they're going to do that by design, right? Like if you think about the engine that the Australian or the New Zealand or the British or the Canadian or the American economy needs is that we need constant credit creation in order to pay down the old debt that gets issued. And so in order to drive that constant credit creation, we need better and better deals in order for people to take on more debt to buy these houses, because the main driver of credit creation is generally mortgages in the economy, right? And then obviously some small business loans and stuff like that. But that, like, what we're gonna see over the next decade is this increasing desperation by governments to keep the system going.
Well, that's like the 5% deposit is just an example where it's all these young people are going cha-ching, cha-ching, and I'm just going, this is an absolute debt trap. Your mortgage is going to be like 40 to 50 years instead of 30.
Exactly, exactly. And what you're going to see is as things get harder and harder to perpetuate the credit creation, they're going to see more and more like better deals, right? So obviously, the 5% deposit with the 15% insured by the government is one way that they're doing that, and then you've got um, they'll potentially remove stamp duty over the next 5 to 10 years to try and promote credit creation and mortgages, right? If they feel they have to, and then they will reduce interest rates, right? So you've got our the RBA head of the RBA saying, "Oh, well, I don't know about interest rates going down," but then at the same time, you've got this government that needs to generate credit creation, and they're saying, "Oh, don't worry, 5% deposit." But in order for people to credibly afford that, interest rates are going to have to go down, right? And so you've got this juxtaposition in the economy where like the central bank wants to talk down inflation by saying, "Oh, we're not going to reduce interest rates," but then mathematically they're just going to have to in order to keep the system going, right? And I think Gen Z should be kind of angry, like they are being stolen from, they're being robbed. And this graph here shows how, right? So this is minimum wage in Australia and New Zealand between 1971, when we depegged from the gold standard, to 2024. And what we can see is on the left hand side, we've got the nominal minimum wage rate. So back in the 70s, it was like $1, $2. And then we've climbed up to what we have today in the $24 an hour, which is that sort of minimum wage rate in 2024. And we all think, oh, that's good. Obviously we've increased our minimum wage rates. But when we adjust this for money supply and we adjust it for population, if we adjust 1970 wage rates for that money supply and that inflation, we see that actually the equivalent minimum wage rate today, if you were being paid minimum wage in the 1970s, would be more like $130, $150 an hour, right? Which would be like a 250K wage rate. And so that is why no one can buy any houses, right? Like the equity being built inside these assets, inside these houses, is actually purchasing power stolen from the laboring class, right? So that is the distortion that we create in the economy, like by printing money, because the money gets printed, the assets absorb it, and then it debases the wage rates, and we can then measure that quite comfortably once we start adjusting things for money supply, right? And so the money that has been reallocated from the labor market has been allocated into the equity of assets. And so that's essentially the theft that Gen Z are experiencing.
Do you think, like, to a degree, like I haven't looked into this, so this is just me making assumptions, but foreign investing into Australia, where it's almost like Australians themselves are struggling to buy property, and so they almost look elsewhere. Do you think that's a factor that comes into these sort of numbers where it goes, all right, someone come invest and buy this property, buy this farmland, even say immigration to a degree where it's like selective immigration, where they're allowing very, very wealthy immigrants to come in and basically plant themselves in Australia over the last 20, 30 years, and they're buying up so much property. Do you think that's a factor that goes into it, or do you think this is just a target on general Australians?
I think it's just the nature of the system. And like the one thing that I want to emphasize, right, is that this isn't like some sort of like evil thing that the Australian government has done to its people. The Australian government and the New Zealand government are trying to navigate a global economic order, right? And they're doing the best that they can, right? So I'm not trying to spin and say this is all the fault of the Australian government. Like they are trying to navigate a global economic order that has been instituted by the United States, and they want to align themselves with the United States in order to build that security guarantee, right? Which we all need, but it does come at a cost, and this is that cost that we're seeing, right? Which is in order to, uh, maintain that alignment, we have to debase our currencies in line with the US. Now, the US has that privilege of being able to export its inflation because it just prints the money and then shifts it out overseas, but New Zealand, United States, Canada, Australia can't, right? And so our countries are forced to navigate that order the best that we can without being able to export our own inflation. So what do we need? We need our economies to be growing resiliently. So what do we need to do that? Well, we need, a consistent population growth, and we need house prices to be going up in order to facilitate credit creation so that we can increase our money supply and we can keep our currencies in line with the US so that we can trade globally and we can access those international markets so that we can trade. So I wouldn't go so far as to say that this is all like an evil ploy by the Australian elite or the New Zealand elite or whatever to destroy its younger generations. It's just a byproduct of the system that our countries are finding ourselves having to navigate, if that makes sense.
I would like if you could maybe go into that relationship we have with the US a little bit deeper, just because growing up for me, I used to think, oh, well, our dollars, say at that time, $1.50 to their dollar. And I used to just think, why don't we just print a little bit less than what they print and our dollar will get stronger and stronger and stronger. And suddenly, maybe deflation starts to come in. And it seems like anytime the US makes a big move, we have to then follow, whether that's a few weeks or a few months or even a few years after. We have to match their trend with dollar debasement. And it seems like maybe the rest of the world's doing that too, because US, even after as much as they print, they seem to be the strongest currency still, the global reserve currency. So could you maybe explain the relationship that we have with the US and how that affects our dollar debasement?
Yeah. So back post World War II, right? We had the Bretton Woods meeting, which was where the US and its victorious allies came together in order to decide what the economic order would be after World War II. And the system was that basically the US would store everyone's gold, including its own, and it would peg the US dollar to gold, and then every other currency would have a fixed trading exchange rate with the US dollar, which would then essentially make it good as gold. And that was the economic order that we had between 1945 and 1971, right? And that was broken by, obviously post World War II, the US found itself in a Korean War, and then it found itself in a Vietnam War, and then it decided to go to the moon. And it did all these amazing things, but countries were realizing that in order to do that, they were creating more money than they had gold to back, right? And so I think in the late 60s or very, very early 70s, the French turned up with one of their battleships to New York and basically asked to load up all their gold onto their ship and leave because they knew that it wasn't working. So basically, gold was starting to flow out of the US as people realized that there was too much money. And then Nixon, President Nixon of the United States basically came out and he said, look, I'm depegging the US dollar to gold. And because of the economic order that we had created in World War II, what he did is he didn't sever the US dollar from gold. He severed all currencies from gold. And that was the big change that happened in the early 70s. And so what we found ourselves doing is transitioning into this global fiat economic order. Now, obviously, we've had monetary debasement occur throughout history, throughout the last thousands of years, but generally it's been isolated to a single country at one time, right? Whereas this time, it was the whole world at once depegging. And Australia and New Zealand had to depeg because otherwise, if we were to print money at a rate slower than the United States, we'd find ourselves, our currencies getting stronger, which would then make us more expensive as exporters, and we would destimulate our economies. And then if we destimulated our economies, we wouldn't have the credit creation in order to facilitate the credit growth that allowed things to continue. And then our systems would actually collapse, right? Because if you have deflation in a debt-based system, the system collapses. And so that's the circumstances that our countries have found ourselves in. We've gone, oh, we have to play this game. And we've been able to play it for 30, 40 years, but in the last, 20 years, it's really starting to not work for us. And you can see that in, the orders within these Anglosphere countries sort of slowly breaking down as they try and sort of basically pay for the weight of being aligned with the United States. And so I think there is a real opportunity for the Anglosphere, New Zealand, Australia, Canada, the UK, to have a rethink about how we build a more sustainable relationship with the United States. I think we could all agree that we probably do want to be aligned with the US and that it's a good thing and that the US is by far the best superpower that we could have. But at the moment, it's being done at a cost that's not sustainable, and we need to figure out, we probably do need to think about how we reset that relationship or how we structure that relationship so it is sustainable.
I think a lot of people are now advocating to return to gold as a store of value and for money, and I think we've seen it rip recently over the last few years. Like it's done some pretty crazy gains. I just think that gold has actually been, if you put anything against gold as the measurement, it's just such a reality check. Like the S&P, everything else is just actually down in gold terms. And so gold's basically stayed the same. Gold hasn't got any more fancy. If anything, since 1971, I'd say the supply of gold's probably doubled in that 50 years. And so could you maybe explain why you think gold continues to rip, even though it's sort of staying the same shiny gold rock? And why we shouldn't just return to gold as the money, as maybe this is the solution. Like every other time in history, oh, we've been trading with beads and seashells. We got it wrong. Let's return back to gold. It seemed to have worked to a degree. Could you explain why maybe gold isn't the solution and how Bitcoin could actually come on top as the global money, as the money that Australia and New Zealand could return to, something that people should be holding as a store of value?
Yeah, gold is interesting, right? So obviously in the 1970s we depegged from gold, and then in the 1980s we had this gold bubble, right? So if you look at the price of gold, it shot up in the early 80s and hit a peak, and then it collapsed down, and it didn't make an all-time high for decades. And now we're at the point where things are just going bonkers, right? Now, if you adjust gold's price for money supply, gold is still nowhere near as highly valued as it was in the 1980s. So it's not in bubble territory yet, even though it's at $4,100 a coin. It's just starting to enter. I'd just say it's just starting to leave its fair value channel on a monetary adjusted basis, right? So it is highly valued at the moment, but I wouldn't say it's in a bubble. Uh, gold is basically sort of an impaired form of Bitcoin, right? It's physical. It's very heavy. It is very divisible, right? You can chip up tiny little spots of it, but the main reason it's impaired versus Bitcoin is that it doesn't have a fixed supply. So gold, Bitcoin's growth rate will tend towards 0% per annum, right? Which dictates scarcity, whereas gold has a growth rate of approximately 1.3% per annum, right? So gold grows at 1.3% per annum, and that is its like relative scarcity, right? So if you think of fiat grows at 7 to 9% per annum. I think in Australia it's closer to 9%. And then you've got silver, which grows at 2 to 3% per annum, right? And then you've got gold, that's at 1.3% per annum approximately. And then you've got Bitcoin, which is trending towards 0% growth rate, right? And that is how you measure relative scarcity. And so that's why gold is kind of impaired. It's like the analog store of value. And that's my reason why over the long run Bitcoin is the superior store of value. It's a purely scarce asset. It's the first truly scarce asset. And obviously, if you have a strong price in gold, you're going to get a strong miner reaction where miners will find new pockets of gold that are economic to mine, and so new gold supply will come on. Whereas Bitcoin doesn't have that supply response. Bitcoin's issuance is fixed. So that is why I think why I think Bitcoin is superior to gold.
A lot of people look at their two market caps and sort of assume, oh, Bitcoin will pass gold in market cap. And so you obviously can't put a time frame on that because that's trying to switch from analog to technology as a store of value. But what do you see playing out in terms of, do you think they run up together? Like, do you think it's kind of everyone leaves the fiat traditional system to a degree and flees to gold and Bitcoin as like a pair, and they're sort of just like going up together, and maybe Bitcoin does reach the $25 trillion market cap, but by then gold's at 50, 60 and still going up? Because I think a lot of people assume everyone's going to start selling their gold and flood into Bitcoin, but I think everyone will sell everything else first and flood into Bitcoin. And I think gold will continue to be this superpower with Bitcoin. I can't quite see people selling gold for Bitcoin in a short period of time. I think that takes potentially 50 to 100 years. But what are your sort of view on that?
Yeah, I generally agree. I think gold and Bitcoin will do well over the long run. I think you're right. People will sell anything else that they can find in order to buy Bitcoin or gold. And I think there's a generational divide as well, right? So if you think about gold's recent price moves, like gold has added like multiple Bitcoin market caps to its market cap over the last like few months. And so that is just shows you the power of the amount of capital that is flowing into gold. It's huge, it's tremendous, right? And that really represents the established thinking around what is a monetary asset. And Bitcoin really hasn't managed to have its move yet, which I'm hoping that it will. But the momentum in people's intellectual understanding of gold as a store of value versus Bitcoin as a store of value is massive, and you can see that in the fact that gold can add an entire market cap of Bitcoin in space of a few months and do it again. And so you really have to appreciate that. I agree that gold and Bitcoin will move up together. I think they'll work complementary for a long time. I think the Bitcoin beating out gold will be a generational change. It'll be where the old guard sort of start dying out and the new guard are coming in and they're inheriting that capital and they think, well, gold's great, but I also probably just think Bitcoin is better. And so that will take time. I don't know if it'll take 100 years, but I think it will take a generation.
If we see gold move at that rate where it's basically absorbing Bitcoin's market cap within a few weeks, few months, do you think there is a potential setup for Bitcoin to potentially double once that switch is flicked? Like once the switch is flicked for people to go, it's not just a speculative gamble, a speculative asset, maybe it's actually a store of value for the long term, which is something that's happened to me, maybe yourself as well. When that flick is switched, do you see all these pools of capital just come in all at once? Do you think it plays over a period of time, a long period of time? Do you think global adoption explodes? Like when do you see this sudden just squadoosh, like just over the hill?
Yeah, I don't know. That's an interesting perspective. I see that Bitcoin now has got a much more rational institutional type bid on it. Like if you see the price this cycle, it's not had the crazy run-ups and the crazy drawdowns like it's had, and you've got a much more rational buyer and seller, and they're not letting the price get too high and they're not letting the price go too low as well. That is indicative of like institutions, and institutions are different to individuals. Now individuals have a very short time preference, right? If you think of the life of an individual, like we're young for like a decade, like if you're young from 18 to 28 and then you sort of start getting old, right? And if you want to get wealthy quickly, then like your time preference gets very, very compressed. Whereas an institution has this idea of being a going concern, right? They're supposed to be going until they don't. Now, the difference between an institution and an individual, right? And I've been thinking about this over the last few days, actually, is if an individual kind of becomes economically irrelevant for a little while, like we'll be like, oh, sweet, well, maybe you need to be on a benefit, or we'll help you out, and like there's a community around that person in order for them to survive. But for an institution, if you become economically irrelevant, you die, like you evaporate. Your legal structures get disposed of in a liquidation process, right? And no one really cares because it's not a real person; it's just a legal entity, right? And so when I think the rush will come when institutions realize it's about survival, when they realize that there's a competitive edge in the balance sheet, and that focusing, like you think about traditional business that focuses on the income statement, it focuses on the amount of income that they can create, and then the moment they generate any cash and they don't have an immediate use for it, the prevailing theory is that you've got to distribute it back to your shareholders because they're going to have a better use for that cash. Now, in an environment of Bitcoin where your competitive advantage can be created from your balance sheet, and your ability to survive and compete is going to be based or dictated to a certain extent by your balance sheet, that is going to be where the change comes, right? Like you're going to have to survive through having enough scale in your balance sheet to compete with the other guy who's buying Bitcoin. And so that's when I think the institutional game theory plays out. And then I think the time preference for institutions in that scenario kind of collapses, and they just like buy, and the price really doesn't matter. So I think that could be a really exciting transition, but I don't know when that happens. I've been in. I was a treasurer for a multi-billion-dollar company, and I managed about $250 million of debt, and I managed about $1/3 billion in equity. And what you have to understand about the structures that exist in these institutions, right, is that you've got a board of directors, you've got an appointed management, and there is a massive, tremendous amount of traditional thinking going on in there. And if you are to introduce alternative ways of thinking, there is a lot of safeguards to filter out that risky thinking or that risky behavior amongst the board of directors and amongst the senior leadership team. And so there's going to be a lot of buffering before that realization happens. But when that realization does happen, I think the time preference will collapse, and they will realize that if they're going to survive, if this entity is going to survive, it doesn't really matter what price it pays. It just has to accumulate.
A lot of people right now in Bitcoin and in crypto in general are still arguing for the 4 year cycle, just assuming that we've come to the end of the 4 years. We're going to see a pretty red 2026, potentially going into a bear market. People argue how long that bear market's going to go for before we see a pretty decent recovery. And so listening to Michael Saylor, it sounds like his view is the next 10 years is the Bitcoin gold rush. And so forget the 4 year cycles. Don't worry about the dips and things. Just basically get as much as you can over the next 10 years. What is sort of your view on the next 10 years? Is it something that we should be preparing for next year, a bit of red at the end of the 4 year cycle? Do you think it's less relevant now? Do you think an 80% drawdown is still in play? Obviously, this is just speculation, but I think I'd like to hear some of your thoughts about that.
Yeah, for sure. So obviously, in the trading stuff that I do, we're constantly looking at the cycle, and my framework or the qualitative side of the trading approach is macro cycle level momentum, right? And so those are the 4 key buckets that I'm always looking at it. And to me, I see us coming to the very end of that cycle. Like, I think if you put a date on it, it's in the next few days, right? That we should be like sort of starting to keel over into a bear market if you took the 4 year cycle very literally. And so I'm very aware of that. I'm not sold on being like super precise on each cycle. I think that things could extend a couple months and still be sort of within that sort of 4 year cycle threshold. And I think the bull run generally authors the bear run, right? So if we look at the bull run that we've had, we just haven't had the extension, like the major extensions and the major amount of upwards to actually cause a crash. Like, normally in the Mangosteen framework that I use, we have this red band. And if you go into the bull markets, the bull run is always in the top of the red band. Now, currently at the prices we're trading at and the things that are going on in the market, we haven't even entered the red band yet. And so that sort of broad condition for me to sort of say, hey, we're kind of at the top of the cycle is not really there yet. But also, if we do top out, I think we haven't had that high extension, so we're not going to have that big drawdown at the bottom. And so I think the bear market could be an opportunity, but it's certainly not going to be the opportunity that we had last year, where we had the bear market come up, we had extension, we went clearly into the red band, and then we had the interest rate expectations shoot up and interest rates start going up, and then that create a massive drawdown on Bitcoin. Right now, we're an interest rate cycle where interest rates are on the down, right? Interest rates are stable, and if anything, they're going to go down over the next few years, and that's going to buffer out any like massive capitulation. Now, we do have a lot of leverage. There's a lot of open interest in the system, and you could see market makers taking advantage of that by that big drawdown that we had like a few days ago, right? And that basically demolished the crypto market, and you could see the effect that it had on the Bitcoin market as well, right? So yes, we could have a bit of a drawdown. I think 2026, once we've had and we do go into the bear market, 2026 probably going to be a boring year. I don't think we're going to, I don't see like 30K or anything like that on the cards. I think we're going to stay a lot higher just because we don't have the same upwards drawdown to then create the same momentum down on the downwards. So yeah, I don't think 2026 is necessarily going to be a super exciting year. I think it'll be a bit of an opportunity if you're thinking about how do you accumulate your stack of Bitcoin right now. I would just DCA and then maybe keep some on the sidelines for that bear market. But but it's not going to be the same opportunity it has been in 2018 and in 2022, where the market was down 80%. I don't see that on the cards at the moment.
Like, let's take a different approach to 2026. Do you think something could be around the corner where it goes, maybe there could be this ultimate crash? Maybe there could be a 2008 repeat where suddenly all this credit in the system gets found out, which I think we've all found out to a degree. But I think with the chaos of the world right now, with the wars and everything going on, part of me just feels like the next few years can't just be normal. Like, they can keep printing money, of course, and inflation can run crazy. But I don't know, like, what are your thoughts on markets in general, the world in general? Like, is there something around the corner maybe we don't know about?
Yeah, it's an interesting thought. I mean, I have a few thoughts around this, and obviously, we talk about how Bitcoin's gotten a bit boring and not volatile, but the mechanics of the Bitcoin market actually are still very real and still able to generate volatility, right? Like, the vast majority of Bitcoin sits on exchanges and does nothing, right? Sorry, sits in cold storage and does nothing. And only a tiny fraction of the market actually sits on exchanges, market making and generating this price discovery for us at any point in time, right? And so what that's typically referred to as the float, like the float of that's in the market being traded actively, is actually quite small. And so if you do have these market disruptions, the price is being created with only a tiny, tiny fraction of the Bitcoin. And so you can have these big price movements up or down just by sort of the feature of the market that, like, very little Bitcoin actually participates in active trading. Now, the thing that I've and this might sound a little bit conspiratorial, but if you think back to the 1920s, right, if you think about the Great Depression, we had the system where leverage had built up into the market, and like people were leverage trading and going bonkers, and basically the central banks had eased monetary policy that had drawn everyone out into these leverage trading positions, right? Now, as soon as there was any sort of economic concern, the central bank, now normally what you would do is you would issue money and stimulate the economy, right, to sort of get yourself through it. But the central bank at that time actually contracted the money supply. And so basically the central bank margin called everyone, right? And so what you had is this ability for people in very privileged places to margin call every weak hand and then hoover up all these assets that got sucked up, right? And I think we're heading into like a similar vibe of market now, where like everyone is so heavily leveraged and everyone is so exposed to the market that contracting the money supply and creating a margin call for everyone, and then going, oh, you can't pay your debt. Like, sorry, mate, like you got no job. We'll take your house, is like a viable and really powerful strategy, right? And so I think people need to be able to protect themselves from this. And this is why I also don't advocate for young people to go jump up and like grow a massive mortgage, because if that were to occur, you are at the mercy of whatever you've essentially given up your sovereignty to the central bank. You are reliant on the central bank continuing to issue money and keeping that market going, and they probably will until they can't. And when they can't, they probably will contract the money supply so they can margin call and hoover up assets, because our governments just need capital, and they're not. So there's this massive incentive for that to occur. And so I would just keep everyone aware that they should also protect themselves from the opposite of what normally happens occurring. And there is historical precedent for doing that.
Yeah, for me personally, I just think with real estate right now, something just feels off with it. Like, I think I've been talking to people similar age and they're going, yeah, I'm thinking about buying a property. I think I'm buying a house. And some of them are like, oh, 5% deposit. I can actually get one now. And I'm just going like, something just feels off. Like, maybe it's just because I'm a Bitcoiner, but it's like part of me thinks you're never going to be able to pay this mortgage off, but potentially you might be trapped in the system forever. Like, you won't be able to just up and go because you owe this much money and things, and something has to crash. Like, I just now realizing how broken the money is and how broken the system is, I just go, something over the next 5 to 10 years, potentially, even if it takes longer than that, something is going to snap, and there's going to be a lot of horror stories from it. And to me, this is just my opinion, holding Bitcoin, even with a potential crash coming, which I think all markets could, and in that mind, I just picture everyone selling what they can, even with a huge crash, including Bitcoin. Like, I don't think Bitcoin's necessarily safe from that price action because it's all just based off human emotion. I think being able to hold something that, say you have zero point 0.1 Bitcoin into self-custody storage, it's still going to be zero point 0.1 Bitcoin when we come back to reality, come back to society, and we start to recover. And you can actually take that into self-custody and actually hold it. That's the only thing that you can genuinely own. And so even if it had an 80% drawdown and worlds start crashing and there's chaos going around, what would you rather be holding? Something that you're $800,000, $900,000 in debt on a house that they're coming for? Or would you rather potentially give that up? Maybe you're renting temporarily and you're not tied to something, and you have something that you can hold into the future for when things do make a recovery. And so these are obviously just assumptions and speculation. But for me, the most confidence I can have is holding Bitcoin in self-custody. And I think, they can't confiscate something like that. And so as long as we don't have a global internet explodes for the rest of our life and we can never get access to our Bitcoin again. But even at that point, I don't think the main thing I'm thinking about is Bitcoin. I think I'm thinking about a lot more. It's just, I can't see, I just think real estate, especially in Australia right now with all the taxes they're bringing in, and they even want to tax people's spare bedrooms and things. I just go, how is that an attractive thing? Like, it's not an attractive asset to me. It's not an attractive play. I don't have the desire to have this mortgage over my head for the next 40 years being stuck in one location, constantly having to keep the place up to scratch, paying potentially 2 to 3, even 4x by the time I've paid off the mortgage, and then think, oh, this is good. At least I own the house. I don't know. I just think young people need to have a second look at Bitcoin, but also look into real estate and understand that it's not as easy as it seems. And we're not just going to be able to repeat what our parents did. Could you maybe just speak into, for Gen Z, whether it's advice or whether it's something, let's say you could go back into your 20s and go, what would be a strategy right now, 2025? Do I want to be buying real estate? Do I want to be like, what's going to be a long-term play here that could really set up Gen Z to not have this nihilistic view on the future because everyone's so petrified and just thinks life's getting too expensive, I'm not even going to bother? Like, what would be your counter to that and some advice to maybe give some Gen Z some motivation?
Yeah, definitely. I mean, I would, I think property was the boomer play, and Gen Z are at the time where, Gen Z are kind of lucky. Like millennials were introduced to Bitcoin where there was every possible like signal of like shitcoin and distraction out there as well. Whereas we've come to this point now where Bitcoin's matured. It's really just it's sort of separated itself from the crypto markets. There's less distraction. And all you really need to do, right, is buy Bitcoin, and your life is going to be so much simpler. The property play is still going to play out for you. Like Gen Z, they're still going to own property. They're just going to do it a little bit later in life. You're going to own property probably in about 2040, which might seem like a long time, but trust me, when you get into your 30s, time goes fast. And the reason for that is that boomers have created all this expensive housing, and they've created these large monetized housing assets that are very expensive to maintain. And if there's no monetize, like if they're not monetized, they're actually not really that economic to own. And boomers are now retiring. So the average boomer retired, I think, about 2.5 years ago, right? And they are then now going into aged care, and they're going to have to sell these houses in order to fund their aged care and their end of life care. And then not only that, they're going to slowly downgrade into these small housing units, and they're going to be, these end of life housing units. And then they're just going to physically die because they just won't be able to last any longer. And as they do that, their expensive houses will find themselves onto the market, and then they won't actually have a very impressive clearing price because no young person, millennials or Gen Z, can afford to maintain these houses anyway. And so they're not going to be as economically valuable as people think. And then at the same time, they're going to die out of these small housing units that the most logical conversion for these residential aged care villages, once peak boomer has occurred, is for them to be converted into residential real estate, right? And so we're going to find ourselves at around 2040 or 2045 or something like that, with this absolute glut of property. And if you've been a Gen Z and you've been slowly accumulating Bitcoin, you'll probably find yourself being able to buy a house quite easily and quite readily with a small portion of your Bitcoin stack. And you'll probably just buy one because you're like, oh, sweet, like I, need some security for my family. Unfortunately, you're not going to do the whole, went to, like what people did in the late 90s and early 2000s when they were like, I was 17, I worked at Domino's and I was on minimum wage, but I leveraged up my property portfolio 99%. And as soon as I got to 2% equity, I leveraged up again, and then I leveraged up again and leveraged up again. And then over a period of a decade, they made $500 million worth of property. Unfortunately, that play is not available to you anymore. And so just slowly accumulate Bitcoin, keep your options open. The employment market is becoming less secure. So you want to have that flexibility in your capital allocation as well. You want to be able to like move and adapt to whatever situations you find yourself in. But I wouldn't get too worried about what's happening right now. Like what's happening right now is a product of a political environment and a monetary environment that we have right now. And it sucks to be a young person in it, but things are going to move on. And I think Gen Z will be fine in the long run. Just they might just have to wait a few years to let things cool off and re-enter the market, when I think countries realize that they've locked out this young generation. The voting bloc that they've been looking to protect for the last 40 years is no longer there, and they're not economically active and they're not politically active anymore because they're dead. And then the country needs to figure out how it's going to look after the generations that are coming up.
Yeah, I think Bitcoin could really give Gen Z a chance to actually have some value stored into the future with potentially more purchasing power than it does now. And so that's sort of my mentality. I think I'm trying to avoid buying property as soon as possible and give it some time, let things settle. But on top of that, I'm just stacking as much Bitcoin as possible. And I'm hoping with a small percentage, I can buy a property in the future. And so I think it's an interesting idea. It's an opposing idea, but it's definitely worth looking into. Before we head out, just I would give you a chance to plug where people can get in contact with you, watch your content, and then on top of that, maybe some books that you recommend, or just some sort of content you recommend that could help back this conversation.
Sure. I mean, so obviously there's my YouTube channel. You can check me out on Mangosteen BTC on YouTube. And you can check me out on X, Mangosteen TRD. If you want to learn a bit more about what I get up to. Books that I would recommend, obviously Saifedean's Bitcoin Standard is a great book. Another book that I'd recommend is maybe The Sovereign Individual, if you've ever read that. It's a book from like the late 90s that kind of predicts the emergence of a digital money, which is quite cool. But it talks about things from a very broad perspective. What's another really awesome book? The other one, one, if you want to really nerd out on economics, is An Economic History of the World from 1400 to Present, which is a really cool book, but it's dense.
All right. Well, thank you very much for coming on. I'm sure we'll do this again in a few months. And yeah, really appreciate it. This has been an awesome conversation.
Yeah, thanks, Joey. That was really awesome.
See you, mate.